All right, let's dive right into this explainer. Today, we're uncovering the absolute most controllable, yet somehow the most frequently overlooked secret to selling your business for maximum value. Look, if you're an owner thinking about an exit in the next couple of years, you've probably spent a massive amount of time sweating over top-line growth, building a killer team, and perfecting your product. But today, we're talking about the absolute foundation of a lucrative exit, your financials.
Because here's a harsh but absolutely crucial reality. Buyers do not pay for what you tell them your business is worth. They pay for what they can prove it's worth. Think about it. All your years of blood, sweat, and tears building revenue and relationships, they mean literally nothing at the exit table if your books can't definitively back up your claims. Buyers aren't just going to take your word for it when millions of dollars are on the line, right? They need cold, hard proof. So here's our roadmap for today's explainer. First, we'll hit the hard truth. Then, the cost of messy books. Next, we'll walk through the pre-sale cleanup checklist, open up the essential document vault, and finally, map out your target exit timeline. Let's get right into it with Section 1, the hard truth.
Now, this concept really demands a complete shift in perspective. You see, buyers aren't purchasing your past glory. They're buying the future. Specifically, they are buying a predictable, transferable stream of verifiable future cash flow. And to confidently underwrite that future cash flow, they require completely clean, defensible books. If your financials are a mess, that future looks incredibly murky to them. And a murky future? Yeah, that is definitely not something buyers are willing to pay a premium for.
Which brings us to Section 2, the cost of messy books. Let me put it this way. Uncertainty is a literal tax on your valuation. Imagine two identical businesses, both earning $1 million. Business A has perfectly clean books and gets a 4.5x multiple, boom, selling for $4.5 million. But Business B, they roll up with a shoebox full of receipts. Because the buyer can't verify the numbers, they apply a heavy risk discount, and Business B only commands a 3x multiple. That messy bookkeeping just directly vaporized $1.5 million in wealth, simply because the buyer had to price in the risk of being wrong. Ouch. And then there's the timeline trap. 60 to 90 days. Most failed deals, they actually don't die in the very first meeting. No, they die right here, 2 to 3 months deep into due diligence. This is that agonizing wall where deal fatigue really sets in. Both sides have already invested immense time and emotional energy. And then suddenly, the whole deal collapses just because a buyer's accountants find numbers that absolutely do not reconcile. So what exactly are they finding in that critical window? Usually it's stuff like revenue reported to lenders that completely mismatches tax returns, undocumented add-backs, undisclosed related party transactions, or maybe inventory that's just wildly overstated. If these red flags pop up, you completely lose control of your own story and your negotiating leverage. You basically just hand the reins right over to the buyer's due diligence team, letting them use every single unexplained number as a bargaining tip against you. Okay, let's flip the script. Section 3, the pre-sale cleanup checklist. Here is your ultimate 4-step pre-sale cleanup playbook. We are going to separate personal from business, standardize your accounting, identify and prove your add-backs, and finally, clean up that balance sheet. And hey, quick pro tip, ideally, you want to start executing these steps 1 to 3 years before you actually go to market. Step 1, separate personal from business. Commingling these expenses isn't just a valuation issue. It's a massive, massive trust issue. If a buyer finds even one hidden personal expense buried in, say, office supplies, they're going to relentlessly dig for more. You've got to move personal vehicle leases off the books, absolutely stop expensing personal travel or home expenses, make sure any side real estate is titled separately, and politely remove family members from the company payroll who don't actually work there at a market rate. Sorry, Uncle Bob, it's time to go. Moving on to step 2, we really need to standardize your accounting. Look, cash basis accounting is definitely simpler for your day-to-day life, but it seriously distorts your true performance and creates huge timing gaps, especially if you deal with inventory or receivables. You absolutely must work with your CPA to transition from cash basis over to accrual adjusted statements for the trailing 2 to 3 years. Accrual accounting accurately matches revenue and expenses, giving buyers that clean apples-to-apples view so your P&L, balance sheet, and tax returns seamlessly tie out. Now for step 3, we need to talk about 2 absolutely critical valuation metrics, SDE and EBITDA. SDE stands for Seller's Discretionary Earnings. That's the total financial benefit a single owner-operator gets from the business. Now, for larger businesses, buyers are going to be looking at EBITDA, which is earnings before interest, taxes, depreciation, and amortization. These are the standard valuation metrics, and your multiple is going to be applied directly to either your SDE or your EBITDA. Which is exactly why identifying and proving your add-backs is so crucial. Legitimate add-backs, like your owner's salary, personal benefits, one-time legal settlements, or above-market rent paid to a related party, adjust your earnings to show true underlying earning power. But here is the golden rule you cannot forget. An add-back without a receipt is literally just a story. If you're claiming a non-recurring repair or personal vehicle expenses, you must keep a running schedule backed by invoices and bank statements as you go. Do not try to scramble and reconstruct this whole shebang 6 months before a sale. Finally, step 4, clean up the balance sheet. Buyers are going to ruthlessly scrutinize this for hidden liabilities. So you need to proactively write off uncollectible accounts receivable, clear out any obsolete or slow-moving inventory, resolve old unpaid loans and vendor disputes, and confirm your fixed assets actually exist and are usable. A rigorously cleaned balance sheet signals incredible operational discipline, and it removes the leverage buyers love to use to demand escrow holdbacks. All right, let's move right along to Section 4, the Essential Document Vault. Here is a simple truth. Missing documents create delays, and delays create doubt. Your data room must have these core items locked and loaded. 3 to 5 years of reconciled financial statements and tax returns, AR and AP aging reports, customer and vendor concentration reports, all material contracts and lease agreements, plus your organizational chart and corporate docs. Think of your data room as the physical embodiment of trust. The faster and more completely you can answer a buyer's questions, the more you protect that premium price. And finally, Section 5, your target exit timeline. Waiting until you're ready to sell to start this process is arguably the biggest mistake owners make. Here's your target roadmap. 36 to 24 months out, you need to engage a transaction-ready CPA and an M&A advisor. 12 months out, that's when you should seriously consider a sell-side quality of earnings, or QOE review, to catch any red flag issues entirely on your own terms. And on your exit date, you go to market with a 3-year, proven, consistent trend. No suspicious one amazingly good year look, just a rock-solid multi-year track record. So, bringing this all together, clean financials do 3 incredibly specific things for you as a seller. They maximize your valuation by reducing perceived risk, they speed up the deal timeline by minimizing due diligence friction, and they completely preserve your negotiating leverage. When your books are clean, you stay entirely in control of the narrative at that negotiating table. So I will leave you with this one critical question to think about. Are your financials telling the story your business deserves? You have built an absolutely incredible asset, but if the numbers can't definitively prove it, the market just won't pay for it. As you look toward your exit, ask yourself this honestly. And if the answer is no, well, it's time to start planning your cleanup roadmap today.